QuickBooks Pro Plus Desktop 2022 OneNote presentation. Make loan payments. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introduction in the 8022 Make Loan Payments tab. Also take a look at the immersive reader tool, topic introductions in the text area too. Same name, same number, but with transcripts. Transcripts that can be translated into multiple languages and either listened to or read in them. Same name and number as presentations as well. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give account and background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're starting out with our screenshot of the home page. We're going to be making payment for loan payments, which will be typically done with a check type form, as it will be decreasing the checking account. You may also do it by going into the register, which would be a common format for writing this transaction. Focusing in on the balance sheet, the account of the loan payable at the $72,000. We created our amortization table last time. Now we're going to be recording two payments so we can see the difference in the two payments. Now, just realize that when you're thinking about recording the loan payable, there's a couple things you want to keep in mind. One, you might not have the amortization table, which you might get it from the lender. You might make it yourself, as we did in the prior presentation. You might ask the CPA firm to make the amortization table. And two, you might then consider whether or not you want to be breaking out the interest and principal when you're recording the transactions into the system, or whether you would like that to be done periodically, possibly at the end of the month or year by the CPA firm, which can be an easier way to go in some cases, because then you can basically be on the bookkeeping side or the accounting side, more of a cash basis. You can memorize the transactions and just record everything to the loan payable, and then allow the accounting firm to then break out the interest periodically according to the amortization table, and break out the short-term and long-term portion of the loan periodically, monthly or yearly. So just keep that in mind. We're not going to do that here, however. We're going to have our one account, not a short-term and long-term portion, just the one account, $72,000. And then we're going to be making the payment related to it with the amortization table. We have the payment for the first payment of the $1,358.73 according to the amortization table. That remains the same. That's going to decrease the checking accounts. The other side's going to go to the $300 for interest, and then a reduction of the loan payable of the $1,058.73. Note that that will differ to the second payment, which is part of the problem because you can't really memorize the transaction as easily, given the fact that these amounts will change from payment to payment. So here's our check form. If we go down below, we got the interest is a $300, the loan payable is a $1,058.73. That then means the checking account's going to go down by the $1,358.73. So checking account goes down, interest expense, and then the loan payable is going to go down. If we then go to our trial balance, the checking account went down. The other side went to the loan payable, which is now at the $70,941.27. That should match what's on our amortization table, $70,941.27 after payment number one. And then if we scroll on down to the interest side of things, we've got our interest at the $300, which we can also see on the profit and loss. $300. Now we're going to do payment two. We're going to imagine this happens at the end of the month. So we're going to do them right next to each other, which you would not do in practice because they wouldn't happen two at one time. But we're going to imagine a month has passed just so we can see the difference between the two transactions and the problems that that could cause. So we got another check. The amount is the same, but the interest and the loan payable are different. The reason this is a problem or an issue or can make more difficulty is that you can't just memorize the transaction as you could if all the amounts were the same, and therefore you got to go in and tinker with it every time you make the payment. And if you're doing something like bank feeds or something like that, you got to deal with the fact that you got two accounts instead of one, and they're going to be different. These two amounts are going to be different. You need to tie it out to the amortization table. So then if I go to the trial balance, the loan payable goes down to $6,987,813. That should match our amortization table, $6,987,813. And then we've got the loan, if I look at the two amounts here that we made, at the end, here's the two amounts. The amounts are the same in the checking account. That's not where the difference is at. And then in the trial balance, we got the loan payable was up top, and then we've got the interest expense here that's being recorded as well. Here's the interest expense, and you can see the difference between the payment 1 and the payment 2. If we did this with our journal entries, what we're going to try to do is mirror what we did in Excel in QuickBooks in essence, and we're going to try to show the beginning balance and the year to date. So we got two trial balances where we start at. They're the same on the balance sheet, but then on the income statement side of things, if we look at just the current month of February, we're starting at zeros because we closed out the prior period to the equity accounts. And then if we look at the year-to-date side of things, we got the January data is still in place. So we're going to do the same kind of thing. Here's our first transaction according to the amortization table, debiting the $300 interest expense, debiting loans payable, and crediting the checking account. What will that do? Checking account's going to go down for both February and year-to-date because it's a balance sheet number. The loan payable is going to go down for both February and year-to-date because it's a balance sheet number, and the interest is going to go up, and that will bring down the net income. That happens from both the February and year-to-date information, but if I look at the net income as a whole, for February, this is all we've done thus far, therefore we have a net loss. For the year-to-date, we had $7,427 net income. Before this transaction, $300 decrease brings it down to $7,127. So the checking account was at $88,811. It goes down by the $1,359 to $87,452. The loan payable was at the $72,000, goes down by the $1,059 to $70,941, which should match then the amortization table. The interest goes from 0 up to $300. Then we do the second payment, which is here's our amortization table on the right. Slightly different interest and the loan reduction. So if we look at that transaction, it's interest expense, same kind of format, but the interest expense is now at the $296 and the loan payable is a debit of $1,063. Checking account goes down by the same amount, but a different proportion to interest and the loan payable. So recording both of those transactions, checking account goes down by a total of $2,717 in both the February and the year-to-date. Loan payable goes down in both, and same with the interest expense. Although interest expense, we can see the impact on net income as a whole. This is all we've done for the month of February, so we have a loss in the year-to-date column. We had $7,427 net income before it went down by the $596 to $6,831. Checking account then was at $87,452, goes down by $1,359 to $86,994. Loan payable was at $70,941, goes down by $1,063 to $69,878. This amount should match our amortization table, although we do not have the pennies on it. So we got the $69,878 here after the second payment. So that matches there. It does. It totally does. 300 was where we were at before. We had the interest of the 296, brings it up to the 596.